Is this America's desperate attempt to keep things from falling? Silicon Valley Bank, First Republic Bank, Signature Bank, are these the tip of the iceberg? This incident did not only shake the world, but it also demonstrates how fragile regulatory frameworks can be. It took nearly 4 decades for Silicon Valley Bank to be built and just 2 days to collapse. A series of events that spiraled into what caused the second largest banking failure in the history of the United States. How it all started. Going back in time to early 2008, right after the subprime crisis, the Federal Reserve decided to keep the interest rates less than 1%. Now this is in an effort to revive its economy, to make easy access of money. This is called quantitative easing, a mechanism used by the Federal Reserve to make easy accessibility of money for people to borrow and invest. While people loaned more frequently, investors had to look for an alternative opportunity for a better return on investment. While we're at it, let's talk a little bit about treasury bonds. These are debt instruments provided by the government. These will generally have a fixed term and a fixed interest rate. They're also risk-free, meaning at the end of the maturity period, the money along with the interest is sure to be provided. Generally speaking, the demand for investment against Fed rates versus investment against treasury bonds are inversely proportional. Meaning, if the Fed rates are higher, the demand for bonds go lower. And if the Fed rates are lower, the demand for bonds go higher. This concept is important for us to understand how this becomes the eye of the storm for Silicon Valley Bank. To my earlier point, since early 2008, the Federal Reserve rates were lower, meaning the bonds became an attractive alternative for investors. Between early 2008 and early 2022, Fed Reserve rates remained unattractive. However, to combat inflation, starting March of 2022, the Fed Reserve started to hike these interest rates. Although this is normal, what seems rather odd is the pace at which these interest rates were hiked. Between March of 2022 to March of 2023, the interest rates were hiked between 0.08% to upwards of 4.5% in less than 1 year. This meant that the valuation for bonds had to decrease. And when the valuation for bonds decreased, there was unrealized losses looming around. Well, that still doesn't explain how Silicon Valley Bank collapsed. Well, we're getting there. When depositors like you and I deposit money into banks, they do not normally sit idle. The banks take this money and invest it somewhere else to increase their returns. Imagine one day, all the depositors walk into the bank and demand for the money to be returned. Do you think the bank will be able to provide that? Surely not. They don't have that much of liquid cash. They will either need to borrow or sell off their assets. Then what happens if these assets that they hold are devalued or less than what they were originally bought for? Well, that is exactly what happened with Silicon Valley Bank. They held these treasury bonds that started to devalue when the Fed rates started to hike. And also to complicate the scenario for Silicon Valley Bank, all of the depositors started to withdraw money, and to fulfill the obligation, Silicon Valley Bank had to keep selling these treasury bonds at a lower cost than what it was originally bought for. At the end of it all, they were short of a huge sum that meant they were not able to meet all of their withdrawal obligations. This is where the Fed and the regulators had to step in and shut shop for Silicon Valley Bank. Since SVB collapsed, does that mean every depositor would get their money back? In an ideal situation, probably not, but in this instance, the government jumped in and assured that every depositor in the bank would get their money returned. That only meant that they went back to print more money. Would that be a good thing if they printed more money? They pumped more money into the system. What that meant is, there's more money available in the market. People will now have more money, meaning they will spend more for the same. That will drive inflation. This increase in purchase power has resulted in an inflation of 8.5%, which is the highest for the United States in the last 4 decades. These price increases generally spread overseas. When a strong demand from American buyers pushes the cost of essentials and oil, it translates into higher shipping costs and everything else. Like the saying goes, if the United States catches a cold, the rest of the world gets a fever. Well, it would be wrong to say that the US alone is the driving force behind these rising prices. The war in Ukraine has played its fair share. Well, at the end of it all, are these price rises justified? Should the regulators think through their decisions? What do you think? Write your comments. If you like this video, like, share and subscribe. Thank you.